Hey everyone, welcome back to Corporate Decoder. Today EVRG just filed an 8K and I am seeing one big shift that you need to know about. Quick note, this is not financial advice, just my take on public filings for educational purposes. Evergy is paying off a big loan early and issuing new debt, and it tells us something about their financial strategy right now. So Evergy Incorporated, you know them by their ticker EVRG, filed a current report, an 8K on the 24th of August 2026. This form is for reporting major events that shareholders should know about right away. First off, Evergy announced they terminated a significant loan agreement. Back in February of 2026, they took out a $500 million term loan that was supposed to last until February of 2027. But on the 24th of August, they decided to pay it off early. The good news here is that they did not have to pay any penalties for this early repayment. This move suggests they either had enough cash on hand or found better financing options to eliminate that debt. Now, the other big piece of news is that Evergy also issued a substantial amount of new debt. They raised $600 million by selling junior subordinated notes, which are a type of long-term debt that mature in 2057. These notes carry a 6.40% interest rate. This issuance was done under an underwriting agreement with several major financial institutions acting as underwriters. The details of these notes were registered with the Securities and Exchange Commission, or SEC, earlier in August of 2024. This underwriting agreement is the contract that spells out how Evergy is selling these new notes to the public through the banks. It is standard practice for big debt issuances and ensures everything is above board. This supplemental indenture is essentially an amendment to an existing agreement that governs these types of notes. It updates the terms for this specific new issuance, making sure the trustee, which is the Bank of New York Mellon Trust Company, knows exactly what they are managing. It also includes the actual format of the note itself, the IOU that investors will hold. Here we see legal opinions from a law firm, Hunt & Andrews Kurth LLP. This opinion confirms that the notes Evergy is issuing are legally valid. This is crucial for investors to know they are buying something legitimate. This is another legal opinion from the same law firm, this time focusing on the tax implications of these new notes. This helps investors understand how these notes will be treated for tax purposes. This exhibit is a formal consent from the law firm allowing their previous opinion to be included in the company's filings. Similarly, this is the consent for the tax opinion to be used in the company's filings. So what does all this mean for Evergy and its shareholders? Let's put on our thinking caps. The company is actively managing its debt. They are paying off an existing loan early, which signals they might have excess cash flow or are consolidating their debt under more favorable terms. Then they immediately issue new, longer term debt. This isn't necessarily a bad thing. Companies in the utility sector often use debt to finance large infrastructure projects. The fact that they are issuing subordinated notes, which are typically riskier for investors and thus come with higher interest rates, suggests they might be looking to fund something significant, or perhaps they are optimizing their capital structure. The 6.40% interest rate on the new notes is something to watch. For context, the Federal Reserve's target interest rate has been fluctuating, and utility companies often have to pay a premium due to the regulatory environment and the stability of their cash flows. While 6.40% might seem high, it is important to compare it to prevailing market rates and Evergy's own historical borrowing costs. Looking at the broader context, Evergy, EVRG, is a regulated electric utility. These companies usually have stable revenues, which makes them attractive to investors seeking income. Recent news shows that institutional investors like BlackRock and State Street Corporation hold significant stakes. And there have been recent purchases by investment firms like Magellan Asset Management. Limited, this indicates continued confidence from large players in the company's long-term prospects. Also, Evergy recently topped its second quarter earnings and revenue estimates, which is a positive sign for their operational performance. However, issuing new debt always comes with risks. Higher debt levels mean higher interest payments, which can strain cash flow, especially if revenues dip unexpectedly. For a utility company, regulatory changes or unexpected operational costs could put pressure on their ability to service this new debt. The fact that these are subordinated notes, meaning they are lower in priority than other debt if the company were to face bankruptcy, adds another layer of risk for the holders of these specific notes. What I am actually looking for is how this new debt is being deployed. Is it for necessary upgrades to their grid, renewable energy projects, or something else? The repayment of the earlier loan and the issuance of this new. Longer-term debt suggests a strategic move to manage their financial obligations and fund future growth. It appears Evergy is actively refinancing and potentially expanding its debt to manage its financial strategy. That is my take. Stay decoded. If you found this analysis helpful, please like and subscribe. And join our Discord community for more insights.